because Max or someone else underwritten the paper that it's legal and it's foreclosable. We want to make sure that the collateral is foreclosable. So our attorneys will review it as well, and make sure it's foreclosable, legal paper. Because performing assets great, doesn't matter if it performs forever. It matters if it defaults. That's when the paperwork kicks in. So if you have questions, again, feel free to put in comments or send us an email, and you'll get that. We also have lien position matters. Why? We talked before about the fact that first, second, third, fourth, we can buy a fourth lien, but understand we're going to buy a sniffing a discount, because if it goes to foreclosure and there's not enough money to pay it, we get wiped out. It can happen. Original balance is another item we require. We need to know what the original balance, not what you sold it for, but what the original balance was of the note created.
So after the down payment, what was that amount that you are financing? The amount that you're actually financing?
Yep. Term. What was the original term of the note? Was it 10 years, 120 months? Was it 360 months? Right? What was that term? When was the first payment date? What that helps us do is figure out when the maturity date is going to be. Right? If you originate this date, usually a month and a half later, or whatever it is, we need to know when the first payment was made.
And going back to term, we deal in number of months. So we talk about 240 months or 360 months or something like that. If you just have it in years, that's fine, as long as it's like a round number. So if it's 18 years, that's fine. We'll figure out how many months that is.
But if it's 18 years and 6 months, we
Right.
need to know that.
We need to know that too.
Right.
Would it not be easier to just give you the maturity date?
So
Yes. That too.
Yes. So there's ways to figure out how many months the term is by using formulas and financial calculators. We can, right? And if you're not able to do it, let us know. We can either figure it out for you, or there's different ways to figure out the other numbers through math, through a financial calculator, or through spreadsheet numbers to figure out what that number is. But if you have it, which should be on the note, the term should be on the note, first payment, number of payments, maturity date, and a balloon amount, which we'll get to, right? We need to know the balloon and how much that balloon is for, because if it balloons at a certain date, a certain dollar amount, that changes the monthly payment and the numbers in between.
And we are going to ask for maturity date as well. It helps us just to make sure it's accurate.
Yes.
That there wasn't a mistake where it's 1 month, one way or the other.
Or a modification happens.
Something like that. Or a modification.
Let me ask you, maybe this is a question for Max, but like in a situation where we create a note that's amortized for 30 years, but there's a balloon at 10 years. I've never even done that for the reason of, I thought it was more beneficial to put it out for 360 months.
Sure.
It helps the balance.
Go ahead, Max.
Yeah. The biggest issue is there's certain risky features that are prohibited in Dodd-Frank, and then there's other features that you can do them with limitations. If this, then you can do this, but if this, you can't do this. So typically in Dodd-Frank, so we're talking owner-occupied 1 to 4 family, you're allowed to balloon after the 60th month. So if you do want to do balloons, just kind of try to think about it this way. The entire spirit, intent, and flavor of Dodd-Frank is to prevent home owners, right, families, from being displaced and creating another 2007 housing bubble burst. So when we talk about putting somebody into a brand new home, you can't put them in a home that next year, all of a sudden, if they can't refi it, they're looking at being foreclosed on and losing their home. And so the federal government requires a certain standard of consistency and predictability with respect to how soon do the terms of this agreement change. And so for Dodd-Frank, 1 to 4 family occupancy, think about keeping them in there for 5 years, typically.
I actually prefer no balloon. It's if nothing else, it's easier math.
Yep.
In general, I prefer not having a balloon. Dave, do you care?
No, I mean, it's a math equation for us.
Yeah.
But it pretty much doesn't matter to me, because most likely, we're not gonna get there most of the time. Understand, most loans don't last 30 years. They just either paid off, or if something happens to the house, they sell it. So, something always happens. Most people don't hold a house for 30 years. So I'm
Yeah.
not too worried about that.
Just so you guys know too, when we underwrite for you, we can always produce an amortization table for you and give that to you right off the bat. So if you're working with Nathan and Dave, that gives you kind of that opportunity to start looking at that thing ahead of time and get a read on what it's going to look like.
Mhm.
Awesome.
Yeah, perfect.
Question about the form. Feel free to hit the form. It's a brand new form we have. We put it out yesterday. And a caveat, I did have this private message sent to me. No, Nathan and I are two different companies. We're just good friends. So
Yes.
we would make two different offers to you. That's why
Yeah.
we're cooperative, but we're also competitive, right? So, so another thing we mentioned here is that you make sure to give us the P&I, not the PITI. We need tax insurance. You can make it a different row, but just the P&I is what we need. At interest rate, that's a definite thing we need. It allows us to figure out if the payments make sense. It also tells us the loan. If you present me a loan that's a 3% coupon rate, either A, I'm not going to bid on it, or B, if you need me to bid on it, my price would be dramatically discount compared to the balance of loan. Because for me to get a 3% coupon up to say at 8, 9, 10, 12, 14, whatever I'm shooting for, I'm going to give you a significantly lower payment.
So
Most
write
people
it.
out there are looking for a bunch of money and they don't care. But understand the fact that for me to buy a $40,000 note at 2%, it must be a much higher UPB, much higher.
Yeah. So general advice, write it at a high interest rate without going over usury laws.
Yes.
And usury laws are specific to every state. So check that out for whatever state you're in. But as high as you can is great. And that helps us. That helps you get the most money when you're selling it to us. Let's put it that way.
What about taxes and insurance being escrowed? Does that affect the value at all?
Nope.
No.
So if it's not escrowed and you rely on the borrower to make that payment at the end of the year every year,
Yep.
that doesn't affect your risk at all. Okay.
It doesn't, it should, but it doesn't technically. If the borrower doesn't pay it, I have to pay it anyway. And if they default, I'm gonna pay anyway. Right?
Okay.
I can ask them to pay it in escrow. I can always talk to my servicer and get it escrowed if they want to. I can do a mod, but no, it won't affect my pricing now.
One quick point also, when you're talking about trying to get your borrowers qualified, we're talking about debt to income ratio and state specific residual income. Just bear in mind that while you can write a term of almost any number of months you want, it's all usually in your and the buyer's best interest to draw a longer amortization period, because as David or one of them mentioned anyway, most of these transactions won't last throughout the term of the amortization anyway. But what it does for their P&I is dramatic in terms of meeting debt to income ratio. So I have a lot of folks send me term sheets, and they'll send me a term sheet with maybe, let's say, 180-month term. And then when we calculate debt to income ratio, these people are over DTI. And simply by getting a hold of the investor and saying, if you'll bump that to 240 or 360, we can save this deal for you. So don't get wrapped around the axle with the idea that I need the P&I to amortize in 180 months or bust, because a lot of times that will bust. But I don't think, and these guys can correct me if I'm wrong, but from their standpoint, 360-month term isn't going to hurt your value at all, but it's going to bring in a lot broader category of borrowers who can meet that requirement.
Absolutely.
Yep.
Right.
Yeah, a 30-year is pretty typical.
Yeah, absolutely. We just price everything according to an annual return.
Yeah.
So yes, you're going to get a different price if there's 20 years left, but it's just a different risk level and return level. So, Next one we need to know is your type of property. Please let us know if it's land, if it's a mobile home, if it's a condo. What we don't buy is I don't buy land notes. Nathan, do you buy land notes?
I don't know.
Okay. I don't buy things in mobile homes typically. I know a couple of the owner finance people have been mentioning it. There's a little bit different type of note that I'm not familiar with as much as typical real estate and commercial. So that's a little bit different for me.
Same. I don't love mobile homes. I'd look at it, but it would have to be special.
So,
When you say,
yeah.
quick question, when you say mobile homes with land or in the park?
Exactly. That's the problem.
Yeah. Right. So yeah, mobile homes could be land included. It can be a mobile home with rented land. It becomes a little bit fishy for us, which we don't get to. One question we had is what kind of note documents need from us? We're going to assume you're the originator, so we won't get into the other note craziness. If you're buying and selling a note to us, we'll need more documents. But typically we just need the mortgage, the note, and for those who are not aware, make sure you get a title policy. Title policy ensures the fact that there's no liens and it's clear title. If you don't, go get one. That makes it more attractive to us. Make sure there's no additional liens prior to the sale of the property.
And it doesn't cost a lot. It's well worth it.
So all right. So I have an interesting question. So I bought a house subject to that was owner financed. And I ended up having to refinance it because the daughter came in. Long story short, I ended up having to refinance it with a bank. I almost wonder if I should have just bought that note from her. But if I bought that note from her, how would that affect me selling it later?
Not at all. You
Not
can
at all.
resell it. Yeah, I mean, you could broker it out if you wanted to.
Yeah.
You don't even have to own it yourself. You could sell it to us.
Interesting.
So
and then could I still own that house subject to?
yeah.
Because that one got really interesting really fast. I ended up offering her, I think we owed like 65 and I offered her 50 and she ended up taking it, which ended up being beneficial for us. So we ended up doing a cash out. But looking back on it, I'm like, well, maybe we should have just bought the note from her and then sold it. And then, I don't know.
Yeah.
Yeah, you could do that.
But that makes more sense to me.
Yeah, we won't get into it, but basically what you need then is an assignment of that, just like you guys do assignments, but we see an assignment of the mortgage, and then you have the Elan, which attached the note. That would just transfer from one seller to the next. And if we buy the note from you, we'd be creating that same paperwork you're selling to us, and you're basically you transfer the note transfer from your name to our name, and it's a paper process. And then we record with the county records. So it's official that the lien transferred over from you to us.
Very easy process. So there's really not a whole lot involved with that. So yeah.
So as we go down the line, we need the property address, street address, city, the state, and zip code. It allows us to figure out how much the property is worth, so we can figure out these kind of numbers. Maturity date we mentioned before. The current unpaid principal balance, which is the balance of the loan as you move along. Again, if you're using apartments.com, this will be much more difficult to figure out. Recommend moving to a servicer or buying a servicing software and figuring it out and apply payments as per se. Then we
That
also
being
need to,
said, yeah, if you've got something that you've only ever had with apartments.com and they're, especially if they've been totally regular and same amount every month, send that along. We can do the math on it. It's a little bit trickier, but we can do it.
Yeah.
So if you've got something that, oh shoot, I'm screwed. No, not necessarily.
give us a shot.
Send it along. Yep.
Let us know. Maturity date, current unpaid balance, next due date. And we explained before the next due date is next date in part of the amortization schedule, not the last payment received. It's based on the amortization schedule. Most time, if it's performing, the next due date's next month.